The beauty of Peter Lynch's investment strategy is that it is incredibly simple to implement. Thankfully for us, this means that you don't need an MBA from Harvard or to be a Wall Street data scientist from MIT in order to follow his advice. I went through all of Peter Lynch's materials and narrowed it down to the 4 absolute essential lessons you need to know to invest successfully. It would mean the world to me if you could give this video a thumbs up and subscribe to the channel because a lot of work goes into creating these videos. Lynch also says that anyone can be a successful investor, so be sure to stick around. You need to understand something. Let's call it Lesson 0. Lesson 0, there are no natural-born investors, and no such thing as a family. Almost all of Lynch's relatives had a deep mistrust of the stock market because they had grown up during the Great Depression, which is what makes someone a great ambassador. Additionally, Peter Lynch claims that you don't need a high IQ to follow his strategy because you already possess the intelligence necessary to succeed in the stock market if you can add 2 and 2 to get a result that is roughly close to 4. Although Boston College is a great school, it is not Harvard, Yale, or Princeton. Peter Lynch himself had an unusual background for someone working on Wall Street because he studied history, psychology, and philosophy in college rather than the business, finance, or mathematics fields typically considered an entry requirement to get a high-profile job on Wall Street. In retrospect, Lynch believes that studying history and philosophy helped him become a better stock investor. Knowing your edge is essential because the average investor is unaware of the knowledge advantage they possess over professionals. This is what I mean. I work for a large investment fund based out of New York City. The sector of the stock market I'm responsible for covering for my investment team consists literally of thousands of stocks across the globe. Even though I work about 12 hours a day, there's only so much time during a working day. It is literally impossible for me to know every single detail about the thousands of the potential stocks out there. What happens is that there are roughly 10 to 15 stocks that I know incredibly well, and then about 50 to 60 more that I follow relatively closely. This dynamic creates opportunity for the individual investor. Individual investors can focus on the stocks Wall Street are ignoring. Often these companies tend to be smaller in size as they're usually not big enough to get Wall Street's attention. It's incredibly easy to find a list of companies that could be potentially flying under Wall Street's radar. While Lynch was investing in the 70s and 80s, the internet wasn't readily accessible. Here in 2023, you have to use your resources to your advantage to find a list of smaller companies. All you need to do is visit a stock screen like this one, choose the market cap option, and then select small 300 million to 2 billion. After pressing enter, you will be presented with a list of approximately 1,700 stocks that meet this requirement only in the United States and Canada. On this list, there are undoubtedly many excellent businesses that Wall Street investors are unaware of. The second thing you should know about stocks is what to avoid buying. This is probably even more crucial than knowing what stocks to buy. Charlie Munger, a renowned investor, has a proverb that reads, "I want to know where I'm going to die so I never go there." What he means by this is that a big part of success in any endeavor isn't necessarily doing everything incredibly well, rather, it's avoiding making stupid decisions. This is especially true for investing. Meet our friend here. John works hard, lives within his means, and adheres to a budget. His diligence has paid off, as John was able to save $10,000 that he can invest in the stock market. When John visits YouTube once a night, he comes across a quick-witted finance YouTuber who is promoting a particular stock to his followers. The YouTuber claims that the stock is the next big thing and a golden opportunity that shouldn't be missed. Because John doesn't watch Investor Center videos, he is unaware of the modern-day equivalent of the stock tip from a stranger that Peter Lynch warns against. As a side note, make sure to subscribe to the channel if you don't want to become like our guy. Since John didn't know any better, he invested all $10,000 of his savings in one stock, which went on to crash like a heavy rock thrown into water and lost 90% of its value before John caved and sold it. Because the stock dropped by 90%, John now needs to find another stock that will rise by 90% to break even. Unfortunately for Jahan, that is not how math works. John's $10,000 investment dropped to $1,000 and a 90% loss, so in order for him to get back to $10,000, he must find stock that will increase by a factor of 10, which is by no means an easy task. This example highlights how crucial it is to know which stocks to avoid. According to Warren Buffett, there are 2 investing rules. Rule number 1. Never lose money, and rule number 2, never forget rule. The first stock type Lynch warns investors about is the next big thing, which is a stock that is being hailed as the next Amazon or the next, insert major corporation name. These kinds of stocks trade at high valuations, so Lynch advises investors to stay away from them like the plague because any setback for the company will cost them a ton of money. Companies that are diversifying are the second type of stock Lynch advises staying away from. These are businesses that enter unattractive new markets without good reason, frequently by paying a premium to acquire another business. In such cases, the shareholders of the newly acquired business win. Dependence user businesses are the third type of stocks Lynch advises staying away from. These are businesses that depend on a small number of customers for a significant portion of their revenue. Avoid selling wins. Third lesson, don't sell your winners too soon. Many investors have a propensity to sell the stocks that have increased the most in their portfolios while simultaneously increasing their ownership of the companies whose stock prices have decreased. Lynch describes it as cutting the flowers and watering the weeds. I'll share a story with you that I find embarrassing for my own investment portfolio. I've been paying attention to people like Peter Lynch. I've known for years, thanks to Warren Buffett and Charlie Munger, that stock pullbacks can be fantastic buying opportunities. Apple's management decided to stop disclosing the number of iPhone shipments the company made in any given quarter, sending Wall Street and professional investors into a tailspin. Because I am more long-term focused, I was still a big believer in the company, and I thought the stock's valuation was favorable, so I made Apple the second largest investment in my portfolio in late 2018 on concerns about slowing iPhone demand. I sold all of my Apple stock because I made the mistake of cutting my flowers instead of my weeds, which led to the company performing so well. I sold my Apple shares at around $75, only to witness the stock soar to its current price of about $180 per share. I've been fascinated by behavioral finance ever since I first heard Charlie Munger's renowned lecture. 24 Common Reasons for Human Error in Judgment. One of these psychological biases that really stands out when attempting to understand why people sell winners too early is called loss aversion. Loss aversion is one of the psychological biases that behavioral finance attempts to explain the psychological reasons why people do certain things with money. Humans dislike losses more than they like an equivalent gain in this situation. Think about this illustration. Imagine your employer gave you a $1,000 unexpected bonus. Would you be happy? Of course you would, and you probably would have a little more energy the rest of the day. But consider the alternative. What if you had been promised a $1,000 year-end bonus all year long? You would have spent that money in your mind because, in your eyes, it was already yours. You open your year's paycheck expecting to see that promised bonus, but instead, there is a big fat zero under the bonus line item on your pay stub. How would you feel? You would probably be angry and want to look for another job. You would probably be upset with your employer for weeks or even months. How, in this hypothetical example, the emotional reaction to losing the money was probably much stronger than gaining it, even though the dollar amount was the same. When I sold my Apple shares, the value of my shares had more than doubled from the price I paid. Subconsciously, I wanted to lock in this gain by selling the shares before it could be lost to the whims of the stock market. If you understand this concept, you are ahead of nearly every other investor out there, including Wall Street professionals. Focus on the micro before moving on to Peter Lynch's fourth lesson. Focus on the small rather than the big. What I mean by focus on the micro is as follows. Many investors make the mistake of worrying about the state of the economy when they should, instead, be concentrating on what is happening within a particular company and the industry in which it operates. Focus on microeconomics rather than macroeconomics. Microeconomics is the study of private individuals and business decisions, while macroeconomics examines governmental and national level decisions. Macroeconomics is concerned with whether or not there will be a recession this year. Using the auto industry as an example, microeconomics focuses on whether it makes sense to invest in that sector. Microeconomics focuses on things like what the future profitability will be for the industry, what companies will be the winners, and how will electric vehicles change the dynamics within the industry. Many times with microeconomics you can then make a reasonable guess that frequently turns out to be correct. However, macroeconomics is a complete guessing game. Even the most highly respected economists are nearly always wrong in their predictions. To use the words of Warren Buffett, any company that has an economist on payroll has at least one employee too many. If you rely on macroeconomic predictions when investing, there are actually two correct predictions you have to make. The first is what's going to happen in the economy. Given the track record of economists, the odds of someone doing this successfully is low. However, there is also a second thing you have to get correct that isn't frequently talked about. Not only do you have to correctly predict what's going to happen in the economy, you also have to accurately predict how the stock market is going to react. Let me explain what I mean. Let's go back in time to the beginning of 2020 and assume that, by some miracle, you were able to accurately forecast the state of the economy. You correctly predicted that GDP would decline and the unemployment rate would skyrocket from 3.5% to nearly 15% almost immediately. However, in order to actually profit from that prediction, you would have to accurately predict the rate at which inflation would rise from 3.5% to nearly 15%. Compare that to concentrating on the microeconomics of a specific business in the industry it operates in. For example, if you are a huge car enthusiast and you spend all of your free time researching the industry's trends and upcoming product launches, You will likely have a good understanding of which businesses are producing the best products and which businesses are the best. There are many industries where you as an individual investor could have a deeper understanding than the professionals, such as restaurants, where you have a deep understanding of the microeconomics of this particular industry. In this industry, you have an advantage over the professional investor who doesn't understand what's going on. Vogue-themed video games. Computers building supplies. The point is that by concentrating on the microeconomics of an industry you are familiar with rather than attempting to profit off of macroeconomic predictions, you can have an edge over the professionals. Because I want to teach you how to invest better by studying the world's best investors, be sure to subscribe to the channel. I'll talk to you soon.